Today, risks in the mortgage machine. Hello again, it's Martin North from Digital Finance Analytics. Well, there's a post covering finance and problem news with a distinctively Australian flavour. So yesterday, APRA gave evidence to the Parliament with regard to what's going on in and around the mortgage industry. And they said there's no discernible trend in loan defaults yet, and arrears are pretty low, but it is coming, they said.
Noticing any discernible early trends in defaults yet?
Short answer is no. Others may have the exact stats while I'm giving you a quick answer, but the sort of rates of customers who are in arrears is still actually drifting lower, which I don't think anyone thinks will continue any longer. And when we talk to the banks, and maybe John might like to add some more to this, but I think when we talk to the banks, they certainly think there'll be a reversal in the trend. But at present, the arrears rates are actually still drifting lower. So that's obviously pleasing, but probably not a situation that's going to last too much longer. But maybe John?
So thanks, Chair. So the latest stats we've got, Chair, is from June, and we've got non-performing loans at around 0.8%. So that is historically very low. And as Wayne said, it has been drifting lower over the last 12 months. It's similarly for housing, but for small business, slightly higher. I mean, if there's a pressure point, that's probably where it's beginning to show. These are aggregates that we watch very closely, as do the banks. Not just the non-performing loans, but actually the surpluses that have been built up. And anecdotally, what we're seeing is that some of those surpluses, while they're still there, they're being drawn down a little bit more. So we would expect there to be some elevation as we go forward, but albeit from a very low base.
No, thanks. That's useful and look, gratifying to hear at this point, but as you say, may change. I mean, there's the aggregate, but then there's also the distribution of defaults and the fact that I think, again, as you alluded to in your opening statement, there's likely to be pockets of stress. Is your expectation that the pockets of stress are likely to coincide where there might be pockets of rising unemployment? Is that one of the key factors that you're looking at?
Well, again, so yes, well, obviously unemployment's a very significant driver because people, the history of Australian mortgage holders is that while they have a job, they will keep paying, even if they have to squeeze their budget somewhat. But there comes a point if you no longer have the income, you simply can't pay. So unemployment is a key issue. When I think about the pockets, though, I think it will be, there'll be people who had very low servicing capacity even at low rates, people who borrowed at very high rates, high debt-to-income ratios, and there will be people who took advantage of the very low fixed rates that were on offer in 2020 in the midst of the pandemic. Many of those will be sort of 2 and 3 year fixed rate loans, which will, over the next 12 months, need to be refinanced. And for those people, there'll be a significant repayment shock as they have to refinance their fixed rates into higher rates, and the gradual increase in interest rates that variable rate borrowers have experienced will come in one hit to those fixed rate borrowers. So they're the sort of types of loans that I think will be particularly vulnerable. But across the entire borrower cohort, if there are areas of the country or communities or industries where there's a pickup in unemployment, then that's obviously going to be a vulnerability as well.
And so I was going to ask around people coming off fixed interest rate loans. So again, is there a distributional pattern there at all, either by, for example, income or house value or geography, maybe outer suburbs? Are there particular areas where you're looking at what's going to happen when that starts to happen?
I'm not sure. I don't think we have the data that would give it to you by geography. But there's no doubt that over the last couple of years, the share of mortgage borrowers, just general share within the broader community of fixed rates, has gone up significantly. That served its purpose at present because those borrowers have been shielded. But as I said, that will come to an end at some period of time. I don't know whether John...
So I don't think, Chair, we have the detailed distributional data that you're referring to, but like in terms of aggregate, what we're seeing is like 23% of new home lending in 2020 was fixed. So that's quite a change from traditionally what was the case. We look at when those loans are actually maturing as well.
And what was it traditionally?
So traditionally dominated by variable rate lending. So there's a much higher rate, as Wayne said, of people taking out fixed rate lending at very low rates in 2020. And so we do have a good picture of when that maturity is in aggregate, and around the middle of next year, my recollection is that's probably the peak of people coming off fixed rate loans. And if you can imagine them refinancing at a significantly higher interest rate, whether that's variable or fixed, that has the significance of being quite a big shock for those people. So in aggregate, that is what we'd look for.
Yeah. No, I'm sorry. What I meant was so it's 25% now, were you saying, that are fixed?
23%. Yeah.
23. And what would it ordinarily be?
So we can come back to you, Chair, with that data, but I think we would say that the percentage of new loans being taken out in the past would be much more dominated by variable rate than fixed rate lending.
Yeah.
23% of fixed rates over a period of 2 years. So I've now got the stats for your question on variable rates. So if you go back before the pandemic, over 80% of home loans were variable, and that dipped to around, just looking at the chart, maybe half, 50%, around July 21, and that's up now to back up to 80%. So it was high, then went lower, then it's gone higher again.
Right, but there's a big cohort there about to come off.
Correct.
Home loans and arrears, and you touched on very briefly, but we didn't go into impact on small business. One of the things I think described very well, the small pockets of stress that exist, and they sit alongside pockets where opportunity has been grabbed and seized, and some people have gone ahead very, very well. I guess a challenge for us is seeing a view that is nuanced enough to identify where those pockets of stress are. With regard to small business, is there some commentary you could give on that in a similar vein to what you provided with home loans particularly?
Well, maybe I'll start and then I'll see if John wants to add, or others, colleagues, want to add anything further. I mean, one of the things we saw through the pandemic, and this goes to your point about trying to dig beyond the aggregate, was the pandemic. For some industries was extremely tough, but there were some industries that actually did well as business shifted around, and businesses that were located in CBDs, for example, as CBDs vacated, did poorly. But if you're a cafe in the suburbs, you might have actually done okay because everyone was all of a sudden working from home. So it was very patchy, and you had to and there were some industries, accommodation, hospitality, etc., which were very badly affected, and other industries far less so. So the key lesson, which is probably not telling you anything particularly insightful, is the need to get beyond the aggregate and drill in and look at regions and look at industries. We've got probably not the greatest data on that sense to give us really good insights, particularly geographically, but what we can see thus far is the story on small business is as John said, arrears are higher than in housing already, so we start from a higher level of arrears. But at this stage, the data shows that they're not trending up yet.
And sorry, just before you jump in there, John, I'd expect intuitively that would be a standard situation. Small business taking on a higher risk, as it would be.
Yeah. Yes.
So, I mean, I don't have a lot to add. I mean, not all small business is very varied, so different types of industries and size. We talked about the non-performing aspects. They are low, but they are trending up, and that data's a little bit dated. So, with a couple more interest rate rises that we've seen, I think you'd expect that to move up as well. In terms of new lending, the banks are saying anecdotally they're still lending. There's money there to lend for good business opportunities, but for new business, like I think if you look at the credit growth numbers on small business, I mean, they are affected. So that's so it's not just the non-performing ones, it's the new ones actually coming in that I think are struggling as well.
Would be a fair expectation that would continue to rise?
Yeah, so we would expect that to continue to rise, and we don't forecast it. But if you think that you can see credit growth starting to plateau, you can see interest rate rises starting to bite, you would expect that to continue. It's a normal part of the cycle.
And just back to home loans, one of the, I guess, areas of interest is who was borrowing, and whether we're seeing in some reports that there was a increase in maybe people who were more financially stable, being able to multiply, let's say, rental acquisitions as opposed to new homeowners coming in. I guess that would have a pretty significant difference in impact on their risk with regard to arrears. Would that be a fair statement?
Well, it sort of depends. I mean, what we did see through through 2021 and the start of this year was that housing loan commitments to owner-occupiers were sort of, they were high, but they were steady. But investors were the ones that seemed to be driving the growth in new credit. So investors coming back into the market, as I think, maybe a sense of the pandemic was over, or seemed to be the worst of it was over, because I hesitate to say it's over. The worst of it was over. Interest rates were still very low. Housing prices were starting to accelerate. And so housing looked particularly attractive for investors at the time. So we did see, if you're thinking who was sort of actively stepping in and growing, which sector, it was the investor sector. Now, the investor sector tends to have higher levels of debt relative to income than owner-occupiers. And so, they will behave differently, I think, in terms of their response to high interest rates than maybe, than owner-occupiers. So there's behavioural differences there.
Over the last few years, APRA's sort of tightened up the requirements about lending for investment properties, and in particular imposed some limitations around interest-only periods, such that once you get past generally 5 years or so, there's a requirement to move to principal and interest repayments. I know Mr. Hamilton touched on the issue of investment lending earlier, and certainly my experience in my electorate is that rental properties are very hard to find. I'm not seeing any uptick in investors buying property in my area. Have you done any work to identify whether there's a link between the tightening of those investment loan criteria and either increasing rents, which we're now seeing very significantly in parts of my electorate, but also around the country from many of the stories we see, and those tightening regulations around investment loans and interest-only periods and moves to principal and interest?
Yeah, so I couldn't say we've got specific research that answers that particular question. What I'd say, though, is just to be clear, I mean, what we've done is tried to make sure that, ultimately loans need to be repaid. So it is important that as banks make loans, that they're thinking about a customer's ability not just to pay the repayments during the interest-only period, but also at some point to repay the loan. And while I know there will be some investors who will say, well, my means of repaying the loan is to sell the property and pay the debt off, I mean, it's not good banking to be relying on that sort of practice. You should make sure that your customer's got the capacity and the cash flow. So that has been our focus. We, APRA, haven't put any limit on the term of the interest-only period. There's nothing in our guidance that says thou shalt not provide an interest-only period more than X years. So there is the capacity for banks to lend for longer periods if they really think that's a good practice. And my final point just to make is that while we do require, and because we think it is sensible practice for a bank to assess a customer's serviceability for a loan on the basis of their ability to afford a principal and interest loan once the interest-only period is up, there's nothing that precludes a customer, when they get towards the end of their interest-only period, from rolling over their loan into a new interest-only loan or refinancing into a new interest-only loan. The only requirement is simply that the banks will do a new credit assessment at that point to make sure that the customer can still has the circumstances and has the cash flow to afford a new interest-only loan. So I was sort of wary of a suggestion that somehow there's a blanket limit and people are locked into a particular loan, because that's not the case.
And essentially, there's nothing to see yet, but it did warn potentially of trouble ahead. And it's interesting to notice that they focused in on the small business sector and suggested some of the early pressures could be there. And of course, fixed rate loans are going to be a definite focus ahead, because many people will switch from lower rates to higher rates, particularly over the next year or so. But the point I want to make is that in their conversation, it's clear to me that they don't have granular information on specific borrowers in particular areas. So they're talking, frankly, a top-down, high-level view, as of course reported by the banks. And it's clear to me that APRA doesn't really know what's going on, because they don't have granular enough information to really get to the bottom of where the hotspots are. Doesn't surprise me. But it is pretty disappointing to me that actually, in the current environment, they don't know where and if and how problems will emerge. Well, let me mark your card, APRA. Firstly, with interest rates rising, and more rate rises, of course, coming, because not everybody has experienced the latest rate rises yet, and with the fixed loan problem ahead, you can absolutely expect to see higher risk in the system, more prospective defaults, and broader trouble. But of course, they will be in the rearview mirror by the time APRA gets to see it, because they don't have the systems and processes to be able to be predictive at all. And by the way, they only look at individual loans, not households as well. So I got to say, APRA, I'm not sure that you're really adding much value in this whole conversation, despite the fact that you are the accountable authority for the regulation of mortgages in Australia. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.